In the traditional game of building wealth, everyone hits the same wall. You trade an hour of your time for an hour of pay. Eventually, you run out of hours, and you run out of energy. The standard alternative involves pouring savings into public stock markets and checking a portfolio multiple times a day. This replaces physical exhaustion with a psychological drain, relying on a lucky spike in a volatile market to get ahead. Relying on daily stamina or emotional bandwidth creates a fragile system. When the investor's energy dips or the market turns, the wealth-building process stalls. By 2026, a specific class of investors has moved away from this model. They are actively severing the connection between the time they spend working and the income they generate. Prosperity in this environment comes from engineering a financial machine. The goal is a system that handles the heavy lifting and compounds assets autonomously while the investor is asleep. Entering this era requires the systematic removal of human effort from the financial equation. The first step involves moving capital away from the high-frequency anxiety of public stocks and into private markets. This invisible asset class includes fractional real estate, private credit, and small business equity platforms. This chart compares volatile public stock swings to a 10% target yield from private credit. Private credit offers mathematical stability public markets rarely match. Securing automated deposits removes the need to monitor smartphones for updates. Emotional energy spent on fluctuations drops to zero. Trading unpredictable market moves for predictable cash flow allows an investor to reclaim their mental peace. While private assets solve the yield problem, managing them still requires oversight. In 2026, investors are offloading this work to agentic AI. These AI agents autonomously handle expense tracking, flag tax harvesting opportunities, and monitor portfolio risk around the clock without human intervention. A traditional human financial advisor operates within business hours and carries high fees. An AI agent runs continuously for pennies on the dollar. An investor leveraging these tools can analyze data and execute trades 10 times faster than someone relying on manual research and spreadsheets. Using agentic AI as a wealth manager eliminates the managerial hours previously required to keep a complex portfolio optimized. The final layer of this wealth stack is the systematic automation of tax-advantaged accounts. This chart displays 2026 contribution limits for HSAs and Roth IRAs, significantly higher than historical levels. Maxing out ensures growth in a tax-efficient environment. Continuous, automatic transfers remove the friction of procrastination, moving money into the investment vehicle before you can spend it. A financial system becomes most effective when it is fully automated. When the process is boring, it cannot be interrupted by human hesitation or poor timing. These three pillars, private assets, AI management, and automated tax accounts, create a functional wealth-building machine regardless of the starting capital. Success in 2026 is defined by relentless, automated consistency rather than high-intensity manual effort. As these tools become more accessible, the primary disadvantage for any investor is the time lost to manual oversight and decision fatigue. Pick one financial process today, whether it's a recurring deposit or an AI expense tracker, and automate it this week to begin buying back your time. To start the decoupling process immediately, use the 2026 financial audit checklist I've left in the description. Start building your system, and I'll see you in the next one.